At the start of 2025, the White House made a jaw-dropping announcement that sent shockwaves through Canada. President Donald Trump was set to impose a massive 25% tariff on Canadian imports, citing concerns over border security, illegal immigration, and drug smuggling. The news spread like wildfire, sparking an immediate uproar. Canadians, from government officials to everyday citizens, scrambled to figure out their next move. Should they retaliate or take a more cautious approach? Some argued that Canada couldn't let its biggest trading partner push them around. Others warned that escalating could hurt Canadian businesses and workers. Prime Minister Justin Trudeau made it clear. Canada wouldn't back down. Everything was on the table, and Canada had to stand united. Ontario Premier Doug Ford took it even further, suggesting a ban on American liquor imports and cutting energy exports to states like Michigan and New York. But here's the catch. The US and Canadian economies are deeply intertwined. Pulling on one thread could send the whole system into chaos. A significant portion of US refineries depend on Canada's oil. If Canada restricted its oil supply, gas prices in the US could soar, and Canada's oil-rich provinces would face severe economic fallout. The energy drama was just beginning. Over in Asia, China's oil game is undergoing a massive shift. US crude exports to China have taken a serious dive, dropping from 150.6 million barrels last year to just 81.9 million this year. What's behind the drop? A mix of factors. China's slowing economy, a growing push for renewable energy, and a shift towards oil from Russia and Iran. But China isn't backing down without a fight. In retaliation for US tariffs, Beijing slapped its own penalties on American energy products. Starting February 10, 2025, US crude oil will face a 10% tariff, while liquefied natural gas, LNG, and coal get hit with a 15% tariff. This move marks a game-changer in global energy politics. China, once the second-largest buyer of US oil, has now fallen to 6th place, a significant drop that could send ripples through global oil markets. For years, China has been the world's top oil importer, fueling its giant economy with millions of barrels every day. But things are shifting. China's overall crude imports have dipped by 7.2% compared to last year. The reasons? Lingering effects from COVID-19, well-stocked reserves, and refinery upgrades. Here's the twist. Even with a drop in imports, China is playing the long game, quietly reshaping its strategy to get better deals and more control over its energy future. Instead of sticking with traditional Western suppliers, Beijing is turning more toward cheaper, politically isolated sources like Russia, Iran, and Venezuela. The numbers tell the story. Energy tracking firms like Kepler show China's imports from these sanctioned nations are steadily climbing. For instance, China's imports from Iran have gone up by 2%. That may sound small, but when you're importing over 10 million barrels a day, that's a huge amount of oil. Why the shift? It's all about money and strategy. Since Russia was hit with Western sanctions, it's been offering oil at steep discounts. And China, always on the hunt for a bargain, has seized the opportunity to snatch up Russian crude at prices far below market value. As for Iran, despite facing US sanctions, it's still finding ways to get oil to China, but not in the usual way. Iranian tankers often shut off their tracking systems, transfer crude to other ships at sea, near Malaysia, for example, and continue their journey under a different identity. By the time it lands in China, the oil is labeled as coming from countries like Malaysia or Oman. Venezuela, also under US sanctions, follows a similar playbook, using complex payment systems and third-party traders to get its oil into China. And since Venezuelan crude is so cheap, smaller Chinese refineries, especially those outside government control, are eager to buy. For China, this isn't just about cheap oil. It's about securing long-term energy independence. By diversifying its suppliers, especially those outside Western influence, China reduces its reliance on any single nation. Plus, buying discounted oil means Chinese refineries can operate at higher profit margins. The result? They can sell fuel at lower prices domestically or flood the Asian market with cheap products, strengthening China's economic grip across the region. Tracking these covert oil trades is no walk in the park, but analysts have their methods. Companies like Kepler and Vortexa rely on satellite images, ship tracking, and port records to track oil tankers in real time. One sneaky tactic: some tankers go dark, turning off their tracking systems to vanish from radar. Others conduct ship-to-ship transfers in the middle of the ocean, masking the oil's true origin. Ports in Malaysia and Oman have become hotspots for these secretive transfers, allowing crude from Iran and Venezuela to be relabeled before it reaches China. Even if Chinese customs records don't officially show these barrels as coming from sanctioned nations, the surge in shipments tells a different story. China is clearly leaning into these cheaper oil sources, saving billions and shifting global oil dynamics. This growing thirst for discounted oil isn't just impacting China's economy, it's shaking up the entire global energy market. Traditional suppliers like Saudi Arabia, Angola, and Brazil are feeling the heat, sometimes adjusting their prices just to stay competitive. This shift has forced major oil producers to rethink their pricing strategies. With China snapping up discounted shipments from Russia, Iran, and Venezuela, Western attempts to curb these flows are being tested. China's focus on affordability is giving it more power in shaping global oil prices. For Russia, China's changing oil priorities have been both a challenge and a golden opportunity. After facing a barrage of sanctions following its invasion of Ukraine, Russia shifted its focus to Asia, especially China. This wasn't just about survival. It marked a total overhaul of Russia's energy strategy. By offering steep discounts on its crude, Russia quickly became one of China's main suppliers. In 2023, trade between the two nations soared past $240 billion, with oil and gas making up a massive part of that total. But Russia didn't stop there. In 2024, China completed the Power of Siberia pipeline, giving it direct access to Russian natural gas. Now, talks are underway to expand that supply through the proposed Power of Siberia 2 pipeline, which would reroute gas meant for Europe to China. This shift has shaken up global energy flows, with Russia leaning more and more on China to take its exports. For China, securing a long-term energy deal with Russia isn't just about getting cheap oil, it's about reducing dependence on Western-controlled markets and building powerful alliances. A prime example of this is China's dealings with Iran. Despite U.S. sanctions, China continues to buy Iranian oil at bargain prices, fueling Tehran's economy, including its military efforts. Washington's response? Stricter sanctions in 2024, but China hasn't backed down yet. While China's oil deals with Russia and Iran often make the headlines, its energy relationship with the United Arab Emirates, UAE, has been growing at a surprising pace. By 2023, trade between China and the UAE had surged to nearly $95 billion, with $83 billion of that coming from non-oil goods. Yet energy still lies at the core of this partnership. In 2023 alone, the UAE's natural gas exports to China topped $4 billion, reinforcing China's strategy of diversifying its energy sources. But it's not just about the buying and selling of oil. Under China's Belt and Road Initiative, state-owned China National Petroleum Corporation, CNPC, has deepened ties with the Abu Dhabi National Oil Company, ADNOC. These joint ventures go beyond securing more oil. They're about embedding China into the global energy network. In mid-2024, China's energy giant, CNOOC, struck a key deal with ADNOC to explore new oil and gas reserves, increase production, and expand the trade of crude and liquefied natural gas, LNG. This deal isn't just business, it's a signal of long-term energy collaboration. But both nations are also eyeing a greener future. China, already a leader in solar technology, has been sending vast quantities of solar panels to the UAE, helping it meet clean energy targets. Economic ties between the two are tight, with Chinese investments in the UAE growing 16%, while UAE investments in China soared by 120%, making it China's second-largest commercial ally in the Middle East. China's deepening partnerships with Russia and Iran could dramatically shift its demand for American energy. With access to cheaper oil from these less politically connected suppliers, China has fewer reasons to rely on the US. It's not just about the price. It's part of a bigger plan to reduce dependence on Western-controlled markets. These energy ties are also tied to China's broader Belt and Road initiative, a massive global infrastructure project aimed at expanding China's influence across continents. As China continues to lean more on Russia and Iran, it could impact the US energy sector in significant ways. With less demand for American oil, crude prices could fall, putting pressure on US oil producers' profits. This could lead to reduced investment in the sector, slower job growth, and even affect long-term economic projections. Trade disputes between the US and China are only pushing Beijing to seek alternatives, making American energy less appealing. This shift has broader implications beyond just oil companies. It could widen the US trade deficit and alter key economic metrics. China's rise as the world's top oil importer has been a huge factor in shaping global oil demand. And now, with cheaper alternatives and a growing focus on renewable energy, China is rebalancing the global energy landscape. China's energy journey began in the early 90s, when it shifted from self-sufficiency to importing oil. And this shift marks the next chapter in its evolving energy strategy. As China's economy boomed in the 2000s, fueled by joining the World Trade Organization and massive investments in manufacturing and infrastructure, its demand for oil soared. By the end of the decade, China was importing over 4 million barrels of crude every day. To keep up, China quickly expanded its pipeline networks and refineries, allowing it to process more oil than ever before. By 2017, China surpassed the US to become the world's top oil importer. Instead of depending on the Middle East, it began diversifying its suppliers, increasing oil purchases from Russia and Africa. By the late 2010s, China was importing nearly 10 million barrels daily, cementing its role in global energy markets. Even during the pandemic in 2020, while global supply chains were in chaos, China capitalized on low oil prices, building up massive reserves to ensure a steady supply. By 2023, China was importing a record 11.3 million barrels per day. But China's energy strategy isn't just about getting enough oil. It's about long-term planning. It's increasingly turning to its BRICS allies like Russia and Iran to reduce reliance on US oil and shield itself from sanctions. These deals are often made in non-dollar currencies, challenging the dominance of the petrodollar. This shift could impact the US oil market by creating a supply glut, which might drive down prices, shrink profit margins, and harm investments and jobs in the oil sector. China's move to strengthen ties with BRICS nations is reshaping global energy markets and weakening US influence.